How Danske Bank's $200 billion scandal shook global finance forever. What if a simple bank account could become the gateway to funneling over $200 billion of suspicious money across borders, leaving a trail of financial chaos that rocked Europe and the world? In less than a decade, one of Scandinavia's largest banks found itself at the heart of a money laundering scandal so vast it shook the very foundations of trust in global finance. This is the story of Danske Bank, a seemingly stable Nordic institution that became a conduit for an unprecedented flow of illicit funds, exposing glaring vulnerabilities in the international banking system. Danske Bank, founded in 1871 and headquartered in Denmark, is a leading financial services group in the region, serving millions of customers in Denmark, Finland, Sweden, Norway, and the Baltic states. Beyond traditional banking, it operates extensively in foreign exchange, investment management, and corporate banking. But why does this matter? Because banks like Danske are the arteries of the global economy, facilitating the movement of trillions of dollars daily. Trust in these institutions is paramount. If that trust is breached, the entire economic system can be undermined. Money laundering, the process of disguising illegally obtained money as legitimate, is a critical threat because it enables corruption, organized crime, and even terrorism by integrating dirty money into the formal economy. When banks fail to prevent this, the consequences reverberate far beyond balance sheets, shaking investor confidence and financial stability worldwide. So how did Danske Bank become embroiled in what has been dubbed the largest money laundering scandal in Europe? The mechanics of money laundering, though seemingly complex, follow recognizable patterns. It generally involves three stages: placement, layering, and integration. Placement is the initial introduction of illicit funds into the financial system, often through deposits. Layering involves complex financial transactions designed to obscure the origin of the money. Think shell companies, wire transfers across multiple jurisdictions, and currency conversions. Integration is the final stage where these cleaned funds re-enter the economy in seemingly legitimate form, ready to be used for investment, luxury purchases, or further criminal enterprises. In the case of Danske Bank, the scandal primarily centered on its Estonian branch, which opened in 2007 and was marketed as a gateway for foreign clients to access the European banking system. Between 2007 and 2015, roughly $200 billion of suspicious transactions flowed through this branch, funds originating largely from Russia, Azerbaijan, Moldova, and other former Soviet states. But how was such an astronomical volume of questionable money allowed to pass through a reputable bank? First, weak internal controls played a pivotal role. While banks are supposed to conduct rigorous know-your-customer procedures and monitor transactions to flag anomalies, Danske Bank's Estonian branch reportedly failed to scrutinize clients adequately. For example, accounts were opened by shell companies with no clear business activity or legitimate purpose. Many of these clients were from high-risk countries known for corruption and money laundering. Instead of raising alarms, these accounts were treated as ordinary clients, enabling massive inflows and outflows without proper investigation. Second, the bank's organizational structure contributed to the problem. The Estonian branch operated with a degree of autonomy, with limited oversight from Denmark's headquarters. When some employees raised concerns internally about suspicious transactions, their warnings were often ignored or downplayed. This lack of effective communication and accountability created a blind spot for illicit activity. Third, the transactions themselves were complex. Money would enter the branch through deposits or wire transfers, and then be swiftly transferred to accounts at other banks, often changing currencies multiple times. For example, funds might originate from a company in Russia, be deposited into an account in Estonia, then immediately wired to accounts in Latvia or Cyprus, and finally integrated into the Western European financial system. Each step made it harder to trace the money's true origin. To visualize this, imagine a factory conveyor belt where goods pass through various stations. Each station represents a bank or jurisdiction that processes the funds. If one station is careless or complicit and lets counterfeit goods pass through unchecked, the fake items eventually enter stores and consumers, undermining the entire supply chain's integrity. The Danske Bank money laundering saga exploded into public consciousness in 2018 when investigative journalists and whistleblowers revealed the scope of wrongdoing. The scandal implicated former bank executives and led to multiple investigations across Europe and the United States. Danish authorities launched criminal probes, and the bank itself faced severe fines and reputational damage. One notable real-world impact was the resignation of Thomas Borgen, Danske Bank CEO, in 2018 as the scandal unfolded. The bank also set aside nearly 2 billion Danish kroner, approximately $300 million, as provisions for legal and regulatory costs. More broadly, the scandal flagged systemic weaknesses in European banking regulation and oversight, especially concerning cross-border banking activities and illicit financial flows from Russia and Eastern Europe. Another case study can be drawn from the United States' response. In 2019, the U.S. Department of Justice launched investigations into Danske Bank's activities, reflecting the global nature of the scandal. Given that many suspicious funds eventually moved through U.S. financial institutions, partly because the dollar remains the world's primary reserve currency, this scandal highlighted how weaknesses in one bank's controls can ripple across the global financial system. This saga also underscored the role of whistleblowers in exposing financial crimes. Howard Wilkinson, a former Danske Bank employee, was instrumental in bringing the scandal to light, helping investigative journalists piece together complex transaction trails. His courageous actions have sparked debates about protection mechanisms for whistleblowers in the financial sector. The Danske Bank scandal did not occur in isolation. It revealed deeper, interconnected vulnerabilities in the international financial system. For one, the case exposed how certain jurisdictions, including Estonia, Latvia, and Cyprus, had become hubs for money laundering due to relatively lax oversight and their roles as financial intermediaries. Additionally, it showed how geopolitical factors play into illicit finance, with dirty money often coming from politically exposed persons and oligarchs in countries with weak rule of law. This scandal also forced regulators worldwide to reassess anti-money laundering frameworks. Following the revelations, the European Commission strengthened its directives on due diligence and transparency, including mandates for centralized registers of beneficial ownership, meaning authorities can better identify who truly owns companies and accounts involved in suspicious transactions. Furthermore, the scandal prompted banks globally to invest more heavily in compliance technology, such as artificial intelligence and advanced analytics, to detect patterns indicative of money laundering. It also accelerated international cooperation between law enforcement agencies, financial intelligence units, and regulators. At a broader level, this scandal illuminated the delicate balance between facilitating free capital flows essential for economic growth and safeguarding the financial system from illicit activity. The case forced governments and financial institutions to recognize that failing to address money laundering adequately can erode trust, deter investment, and ultimately harm honest businesses and citizens. So what does the Danske Bank money laundering scandal mean for you and me? At first glance, scandals like these might seem distant, their sheer scale abstract and removed from everyday experience. But the reality is that money laundering enables criminals to thrive, corrupt governments, and distort markets, which can lead to higher taxes, reduced economic opportunities, and weakened social institutions. On a personal level, it reinforces the importance of transparency and accountability in financial systems. Whether you're a business owner, investor, or simply holding money in a savings account, trust that your money is handled with integrity by your bank is crucial. This scandal also highlights why regulators impose strict anti-money laundering requirements and why you might need to verify your identity multiple times at financial institutions. These measures serve as defenses against financial crime that ultimately protects consumers. Moreover, the story invites reflection on vigilance and whistleblowing in protecting societal interests. It reminds us that systems are only as strong as the people who make them work, and the checks that ensure no one turns them into conduits for wrongdoing. As we move forward in an increasingly interconnected world, the question remains, How can we build financial systems that are not only efficient and innovative, but also transparent and resilient against misuse? Danske Bank's tale is a cautionary chapter, but it is also an opportunity to learn, reform, and restore faith in the foundations of global finance. After all, the true cost of failing to stop money laundering is not just hundreds of billions of dollars, it's the erosion of trust upon which our entire economic future depends. The takeaway here is that trust in financial institutions is essential, and understanding the safeguards in place can empower consumers to make informed decisions. This scandal underlines the importance of regulatory measures designed to combat financial crime, highlighting the need for vigilance and accountability at all levels. Ultimately, the story illustrates that maintaining the integrity of our financial systems requires continual reform and a commitment to transparency, reinforcing the idea that we all have a role to play in upholding trust in the economy. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow we are diving into a story that is just as shocking. Barings Bank: How Nick Leeson Destroyed a 233-year-old Bank. You will not want to miss it. I will see you there.